think, act, and prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show, where we think, act, and prosper. I want to thank you all for joining me today in this new year. I am happy, I am blessed, I am alive, I am blessed to see a new year. I hope you all had a great 2021 holiday season leading into 2022. And I want to give you all my outlook and prediction on what 2022 is going to look like and how I am preparing myself for this journey. So, just to give some context, we have a lot of things that happened in 2021 that I am not going back over to recap, but some of that you will be able to hear in my 2022 predictions because it didn't fully play out in 2021. So without further ado, let's get into it. So number one, I am expecting the Fed to do some sort of taper and raising of interest rates. They have already started this process in late 2021. They mentioned that they were going to taper by 15 billion per month, and they sped it up to tapering by 30 billion per month. So now tapering is the reduction of how much government bonds they are buying to finance fiscal stimulus and fiscal spending. So you have fiscal policy, which is government policy and government spending, and then you have monetary policy, which is the Federal Reserve's spending and what they do on their side of things. So the Federal Reserve buys government bonds from the government, and the government has to pay the Fed back with interest, and that is how national debt is accrued, and that is how fiscal stimulus was provided. When stimulus checks were going out, you still got child tax credits, PPP, things of that nature. The government was able to provide that by selling bonds to the Federal Reserve that they have to pay back with interest, which ultimately increased the national debt. So the Fed is saying that they are going to reduce buying as many bonds as they were per month. They were buying 120 billion worth of bonds per month, and this has been going on since COVID. I believe March of 2020, they started that policy, but then they came out in the fall of last year and said that they were going to reduce it by 15 billion per month, and then how every month they were going to reduce how much they were buying per month. And then they came out with a more hawkish tone of saying that they were going to actually accelerate that process to, I believe, 30 billion per month. They were going to reduce that. And so I'm believing by March of 2022, the Fed should be done buying government bonds to finance fiscal stimulus. Now, this is going to cause some issues in the Senate because the Senate on the Democratic side have been trying to pass this Build Back Better bill. However, this is going to cause some issues as we begin to see this more fiscal gridlock happening again. And we're seeing that the Fed is tightening. They're not going to finance as much U.S. debt because they're seeing that inflation is rising a lot. The Federal Reserve has a few goals that they want to maintain, which is a steady employment rate. And then they also want to maintain inflation. We have seen inflation skyrocket. It's been the highest it's been since 40 years ago. And that was in the 80s. And so when we're looking at this, we're looking at the Fed is going to taper. They're going to stop buying as much bonds, and they're going to raise interest rates. Now, when the Fed raises interest rates, usually that is bad for growth stocks. So growth stocks are stocks that grow very fast versus value stocks which grow slower, and you get a dividend from value stocks. Usually growth stocks are usually the stocks that can go from 50 to $100, even more. We saw a lot of that in 2020, and growth stocks got hammered when the interest rates started to naturally rise last year. It was around March of last year when we saw these stocks start to plummet, and the interest rates just kept going up, which was on the 10-year treasury and the 30-year treasury, and they just kept going up, and then the growth stocks began to get hammered. So that's kind of what I'm expecting to see this time around, just to see how the market reacts. The market is very irrational and emotional. Anything can spook the markets. I mean, we had the Omicron variant come out and people were just spooked, selling off all their stocks, and I was able to go in and accumulate at a discount, and I hope you were able to as well. And I understand that fear happens, but the market is definitely being swayed one way or another based off all these different factors that are going on and playing. And so it causes a lot of volatility in the market. So I'm expecting some volatility to happen around the March, April timeframe when the Fed begins to raise interest rates. Now, how I'm going to benefit off of that is I'm going to invest in some of the financial sector stocks. We're starting to see that bank lending is actually increasing because stimulus has died off almost. Now we're seeing bank lending on the uptrend. So just thinking about stuff like that, banks are wanting to lend more money. Banks have a lot of money to lend, and so they're going to be pushing this lending. Even on a home equity line of credit that I have, the bank increased their little special rate that they had to increase it from. It was supposed to expire in May. They increased that time frame to the end of this year, and so you get a 1% APR on that. And so that's pretty interesting how banks are starting to lend. So I believe that banks and financial stocks are going to do really good, especially when the Fed begins to raise interest rates, because interest rates give more money to the banks. And so that is how I'm playing that sector of things. And then I'm also keeping some cash on hand, because cash is going to become vital whenever we see the market begin to react to the interest rates rising and begin to sell off their stocks. And so I'm looking at accumulating some of my core positions at a cheaper price. And so I'm keeping some cash on hand so that I can be able to buy those dips when they come. So now a second thing that I'm looking forward to for 2022 is I'm expecting the precious metals to rally. And so I say this, a lot of people are saying that, oh, we are in an environment, we have inflation, all these things, and gold is refusing to rally. One thing that I've been enlightened to is that back in 2015, gold had bottomed when the Fed began tightening. So the Fed was doing quantitative easing. We had a big rally in gold from the early 2000s to about 2011. And that's when we saw that gold became overvalued during that time, and we had a sharp sell-off. The Fed was doing quantitative easing as well, and the Fed began to announce tightening in 2015 when gold had bottomed. So since 2015, we've seen gold rally from $1,050, somewhere in that range, to where it is now, which is at over $1,800. And I'm expecting to see that it go continuously up. And so sometimes people look at gold charts and they look at the year over year and things like that. You have to go way back with gold. You have to go further charts back to see the purchasing power of gold continuously increase. And so I am expecting that gold is going to rally in 2022. We saw the rally in 2020 where it went up to over $2,100. And then we saw a sharp correction, which corrected around $1,600, somewhere around there, $1,650. And we saw it chop sideways. And so it's been within that range. And I believe that anything that doesn't break down is going to break up. And so I believe that gold is going to break up. And we're starting to see that now. Let's see if it sustains. But I believe for 2022 that this is going to be an environment for gold to outperform. Now, the third thing is regarding Bitcoin and cryptocurrencies. So there's been a lot of talk about a crypto winter, a crypto crash coming, and a lot of these coins having to be washed out, getting all these investors washed out, because you have more than 10,000 cryptocurrencies that have come online in this past bull run, and people are just throwing their money anywhere. Some of these companies don't even have anything tied to them. A lot of these coins don't even have companies. They're just coins that were just developed, and they're meme coins or whatnot, and they are just rallying, and they are just going up, skyrocketing, going to the moon. And so many people expect that there's going to be a crypto winter. For me, I expect somewhere in the middle that there's going to be a correction, definitely in some of these cryptos. We've seen some of that. I mean, Bitcoin has went down to 30,000, then it went back up, made a new all-time high. Now it's been consolidating in within the $50,000 and $45,000 range. And I expect that Bitcoin is going to go higher. So we'll see about that. I'm actually a Bitcoin miner, so I just started that. And so I'm really not worried about the short-term price of Bitcoin. I'm just worried about dollar cost averaging, as I believe that it will hit six figures at some point, and it may be this year, it may not be this year. However, I'm expecting that crypto is going to go up, but I do expect that there is going to be some corrections along the way that is going to wash out some investors that are just buying just to buy and not really knowing what they're getting themselves into. And so that is what I'm expecting for crypto and Bitcoin in particular. And the last thing on my list is inflation. I expect inflation to continue to rise. So when the Fed raises interest rates, the Fed isn't just going to be able to just tame inflation right then and there. I believe inflation is going to stick around. There's some things that aren't going to go down in price. I mean, we saw lumber spike, we saw used car spike, and many other things spike in price. And you have to look at the underlying mechanics of why these things are spiking. And so we did have some supply shortages and bottlenecks and supply chain disruptions. And those did contribute to things like the used car market spiking up. So you do have manufacturers with a lot of cars that are just sitting there that aren't being used because they don't have chips to get them on the market. So I believe that that's going to be deflationary for the car section of inflation. Same thing with lumber. I expect, lumber to continue to consolidate. It did go all the way up and then it came down and it went up some. And so it's been, not as high as it was before. And so lumber, for example, had the sawmill issue where you didn't have enough sawmills online to get the timber through. There's no shortage of timber. I live in Washington State. There's a lot of trees. There's plenty of trees to choose from. I've seen a lot of trees cut down. It's millions of trees. It's just crazy. And so there is no shortage of timber. It was the sawmills that were pretty much had bottlenecks and they had a lot of product that they had to get through due to the pandemic and a lot of shutdowns and things like that. And so lumber actually came down from those high prices that it was at. And so I'm expecting in those parts of inflation to cool off. However, I'm expecting energy to continue to heat up because there has been a lot of policies and things like that that have really hindered the energy market. So for example, oil, they aren't producing as much because they don't have a lot of capital inflowing into them as there were before. It is not politically acceptable right now to invest in oil. So they are not getting a lot of money. So they have ramped back their production. And this is important because we're going to see the prices of oil continue to go up. We're going to see natural gas continue to go up. We're going to see some of these other commodities, especially the metals and the lithiums and all these different things as they try to push the Green New Deal and reduce carbon emissions and things like that. All of these scarce metals are going to go up. And so I'm expecting a lot of the commodities to rise. I'm expecting rents to continue to go up. And so those are some of the things that I'm looking at, like, okay, these parts of inflation are continue to rise. These parts may come down. However, I'm expecting inflation to stay at a steady rate going forward. I expect it to be higher than what it usually was, which is lesser than 2%. The Fed's target was 2%. We're way over 2%. I think that inflation is going to stay higher than 2% going forward in this year. So I want to hear what you think is going to happen this year. Are we going to have a crash? What are we going to have? What are we going to see? I believe that crashes are going to be very just corrections along the way. I don't believe that we're going to have a major market crash, but I want to know your guys' thoughts. What do you think? Leave it down in the comments. Let me know what you think. And what is your outlook on 2022 and how are you positioning yourself for this year? And so be sure to hit the like button. Be sure to hit the subscribe. I appreciate you all for tuning in today, and you all have a good day. Peace.